Hey everybody, I hope everyone is doing well and had a good day. And today's video might be a little bit longer than usual for a couple of reasons. One is I'm taking this weekend off from looking at charts and from thinking about trading to the best of my ability. So I'm going to do a bar by bar review today because I feel like it. And also I'm going to have some thoughts to share at the end of this video. But anyway, this is the Emini end of day review for Friday, October 25th, 2024. So it's Friday, so weekly support and resistance is important. Market often moves more dramatically on Friday. You typically will see a trend day on Friday because it's the close of the weekly chart bar. So here's the weekly chart, and here we have a bull breakout bar and follow through, but it's a reversal bar. It's almost an outside bar, not quite, but it should behave as one. It's close to an outside bar, so this bar sold off and then rallied, and we're getting follow through. But because we sold off and rallied here, this might be almost an expanding triangle on a smaller time frame, a trading range, and it's following two other trading range bars. Plus, we might be late in a bull market cycle. We have a rally, a pullback, rally, deep pullback, and a rally. And this rally subdivided into two legs, one pullback, two. And you can even say the second leg here is subdivided into two legs, one pullback, two. So probably resistance up here. The problem with selling below this, the prior week's low, is that we've had a lot of consecutive bull bars. It's not a good stop order sell below this bar. There's probably buyers below the bar. And I want to go back to this almost outside bar. Because this was a sell-off and then a rally, we have traders trapped down here. And since we broke out of the prior two bars, we have trapped traders here. But the odds are, if you sell above these bars and you're betting that the market is in a late leg and this is a trading range, the odds are you'll be able to sell above a bar, scale in, and avoid a loss or even make money. And you can see the market is coming back down to test prior highs here. On the daily chart, as we went into today, we have a trading range. And here's the big two legs I was talking about on the weekly chart. One, pullback, two. But this is a big third leg. It also subdivided into two legs, one, pullback, two. And all through here, there's a lot of overlap. And you can count three legs here. One, pause, two, pullback, three. Different ways to look at it. And then a deep pullback here. And it's sort of a big up, big down, big confusion with all of the bars overlapping and really no bar getting good follow through in quite a few days. So here we have a high two buy. We had a high one above this bar and a high two here. But there's a couple problems with the high two. The biggest problem is context. As I've mentioned, this could be a late leg, depending on how you look at it, but even here, maybe it's 1, 2, 3. On the weekly chart, it's a bigger third push. Possible final flag here, bull breakout, bad follow through here, and now the market is probably in a trading range, so sellers above. It's also an inside bar, and inside bars are trading range bars, and most breakouts of trading ranges fail. So even if we get a breakout of an inside bar, they typically get tested within a couple bars. So right here, if you can see my cursor, this is an inside bar. What happened? We got a bull breakout. Market came back and retested near the high of the bar before getting a second leg. So even if we get a breakout of this high two, it's a 5 or 6 bar bear micro channel and an inside bar. So not great, probably sellers above, but the sellers might be at a distance above the bar And why is that? Because if you're selling here, you're sort of selling in the lower part, maybe the middle or lower third of this trading range. Traders would rather sell in the upper third. And then, of course, if you take away context and if you take away the fact that it's an inside bar, just look at the signal bar itself. Yes, it's a reversal bar, but it has a bare body. It's a weak buy signal bar. So you combine all of those things, bad context, inside bar, and weak signal bar, and you know the odds are a breakout above or below this bar will likely fail. So I think probably sellers above and buyers below yesterday. Okay, and let's get into the 5-minute. Yesterday, we had a trading range day. Today, we have a relatively big gap up and a follow-through bar. Good for the bulls. Big enough gap and follow-through that we'll probably get a second leg up. The market accepted the gap, so yesterday closed here, today opened here. You can think about that as just one big breakout bar. Now, if we take a second, this is worth talking about actually. We look at the Globex session going into the day. Here's what we got. Tight trading range and then a tight bull channel. We have a channel line here with several pushes up. Market is attempting to break out of a channel line, which is a low probability event. 25% of the time, the market successfully breaks out of a channel line, so in this case, breaks above a bull channel line, and then is in a stronger trend. 75% of the time, you get a bear breakout of the trend line. The trend line is connecting the lows of the bull trend, so down here. And if you do get a breakout attempt, the market often reverses within 5 bars and then comes back down to test the trend line. So that's the expectation going into the day. And here's the close of the regular session hours. So you can see here's the close and here's the open of the day. That is why there was a gap up. So this fills in that missing information. Because otherwise, you go into this day and you're not sure. Was it a big trading range? Was it a big up, big down, big up? Or was it a strong trend? So that's good to know. So my initial thought for bar 1, after looking at the Globex chart, I'm thinking, well, this probably has a limited upside. I have a slight bearish bias because of the higher time frames. I talked about the daily chart earlier. I thought there would be sellers above yesterday's high, but maybe at a distance. So why don't we look at a measured move? And this is a measured move up of yesterday's range, takes us here. And at this point, the breakout and follow through, if you consider the bodies, takes you above that measured move. So we have a couple of targets for the bulls above. Big bar on bar 1, but also a big tail. And that's not great for the bulls. If this is a strong bull breakout, why are traders selling into the close of the bar? And then bar 2, another not great bar for the bulls. It's an inside bar, and it also has a tail above, so traders are selling into the close. Now, based on the context, this breakout and follow through, If I had to choose, and I think it's important to think through stop orders, if I had to choose between buying above bar 1 with a stop or selling below bar 1, bar 2, buying above bar 2 on a stop order or selling below bar 2 on a stop order, I'd rather buy above it. There's not enough selling pressure to look to sell yet. Even though the majority of the time, 80% of days have a trading range open, so far we have a gap up and then a trend bar and more follow through. So probably there's a chance that this is a trend from the open, bull trend. And then more follow through, bar 3. Good for the bulls. Every third bar is the close of a 15-minute chart bar. So if you can imagine the 15-minute chart, the bar opened at the same price as the open of bar 1, and it closed at the close of bar 3. So this is a pretty strong bull trend bar on the 15-minute chart. Very small tail below and very small tail above. So a gap up and a really good follow-through bar on the next time frame higher. It's probably okay to buy the close here and always in long. It's probably always in long after you see bar 1, if you want more confirmation, maybe bar 2 or 3. But I think once you get 3 consecutive bull bars, it's a micro channel after the gap up and bar 3 closing on its high. I think it's more clearly always in long. If you had to choose to be in the market, long or short here, what would you choose? Again, think through stop orders. Would you rather buy above bar 3 or sell below bar 3? Probably want to buy. For another breakout, but another sell-off into the close of the bar. So what do we have so far? We have a 4-bar micro channel, but on a smaller time frame, the minor pattern. We rallied, pulled back, and paused. We rallied again, but we're pulling back. That's 2 legs up. It's too tight to really consider that a second leg that you're looking to sell. There's really no sell setup here. But if we have a third consecutive buy climax after a pause here, 1, pause, 2, pause, 3, that might be a parabolic wedge. And then we have another pause on bar 5. If you bought the close of 4, bar 5 is fairly disappointing. But if you think about disappointment, you can think about it as a binary decision. Are the bulls who bought bar 4, is that a major disappointment on bar 5, or is it a minor disappointment? So in other words, are the bulls panicking out after they see bar 5? Probably not. To me, this seems like a minor disappointment bar for the bulls. It's not great, but it's a different kind of disappointment than bar 74 was. If you're a bull and you buy the close of 73, that's major disappointment. But here, if you buy the close for, that's not great. You're hoping for momentum. You're hoping it's a breakout pullback buy, and you get a small bull doji bar. But would you rather buy above bar 5 or sell below bar 5? Of course, you would never sell below bar 5. And then bar 6, another bull trend bar. So at this point, we have 3 pushes up. We rallied, we paused, rally, pause, another rally. Now, we're getting so close to the measured move of yesterday's range that we may have to get there, but we don't know how many traders are looking to sell here. Bulls taking profits and bears looking to initiate shorts at a fairly major measured move target. And because it's a parabolic wedge, you're expecting a pullback fairly soon. Now the pullback should be minor. A parabolic wedge is minor. Let me just go one more bar. So bar 7, we're breaking far. I say far. Breaking above the measured move target. Good for the bulls and closing here. But bar 7 is a problem if you're a bull. Why is bar 7 a problem if you're a bull? Now we have 3 consecutive buy climaxes. If you can include the gap up in bar 1, a pause, 3 and 4, pause, 6 and 7. And look at bar 7 compared to the rest of the bars. Bar 7 is one of the biggest bars. It might not be as big as bar 1, 10 and 3/4, and this is 9 points. So not quite as big as bar 1, but the body's bigger. So why are we getting one of the biggest and strongest bull bars? Why are we accelerating in leg 3? And that's often a sign of weakness. And what that is caused by is you have bulls who are not willing to sell because they see an obvious magnet not far above, and there's other magnets. There's other targets that traders can go for. Maybe you go for a measured move of the first 4 bars in the breakout, and it's going a little bit higher. Traders are not eager to sell here if they think it's going here. And if traders know that, then the bulls are not going to take profits until we're at least here, and the bears are not going to initiate a short until we're at least here. Why would a bear sell here if they think we're going here? So that creates a vacuum effect. Traders are in agreement, the price is wrong, we have to go higher to find sellers. But 7 is a problem because it's a gift bar. It's 3 pushes up, and it's one of the biggest bars in the rally. This is climactic, it's unsustainable behavior. At a minimum, we're expecting a minor reversal, probably at least 10 bars and 2 legs. So bar 7, bulls might look to take profits here, but we're expecting a minor reversal. Still always in long, and really no reason to get out of longs if you're trading always in. Another pause, and that's what you expect after a buy climax. Any trend bar is typically followed by 1 to 3 bars sideways. We triggered a sell below bar 8, but it's a trading range bar and an inside bar, probably buyers below. Then bar 9 became a high 1 buy. It's really not great. It's obviously a weak signal bar for buying above, but it's also not a good sell below. And probably there are traders buying below bar 9. We have a tight bull channel. It's even a breakout on this time frame, a micro channel. The first trend line break should be minor, and the first pullback, the first reversal attempt should fail and become a pullback, a bull flag. We sold off on 8, we rallied, sold off on 9, rallied, that's 2 legs down, maybe we get 1 more push, but then trend resumption. And then bar 10, we did get 1 more push down, so 1, 2, 3 pushes down. It's a minor wedge bull flag. It's probably buyers below bar 9 and above bar 10. So there's a stop order long above bar 10. On this time frame, we have a high 1 buy. On a smaller time frame, it's a high 3. 3 legs down and a third reversal up. And then you can see traders bought above bar 10. But after an inside bar and 3 or 4 bars sideways, the market might be converting into the channel phase. And we know that's what it's doing based on the market cycle. We have a breakout, a pullback, and the pullback is the start of the channel phase. So traders will start to take profits at swing highs. You'll have bulls taking profits above bar 7, and then look at bar 10. If you bought above bar 10, you got about 1 times the risk, maybe just below. But for a couple of reasons, traders selling above highs and the measured move of bar 10, there might be some resistance up here. High ones typically fail and then pull back deeper. And then we get bar 12. Bar 12 is another inside bar. It's a bear bar, but it closed above its midpoint. But again, let's think through stop orders. Would you rather buy above bar 12 or sell below bar 12? It's not a very easy decision because you have a very tight bull channel and the signal bar is weak, so really not a good sell below 12. But think about the opposite trade, the opposite stop order. Do you really want to buy above bar 12 when you're basically at the high of the day, but the last time we made a new high of the day, traders sold, bulls are taking profits, and if we are in the channel phase, traders are buying below bars and taking profits above bars. So another high one, but bad context, and we probably will have more sellers above bar 12. And then another inside bar, 13. So we have an II pattern. 13 is inside 12, and 12 is inside 11. And the bears are hoping this is a reversal. Consecutive inside bars, it's a triangle on a smaller time frame. We can even see it here. We're getting higher lows and lower highs. So the market is contracting, it's getting squeezed, and it's breakout mode. So the bulls are hoping it's a bull flag and we get another rally. The bears, again, hoping for a reversal. When you have a breakout mode pattern and the market is this far above the moving average and you've had several buy climaxes, I think it's okay to exit longs below 13. 13's an aggressive stop order sell, but again, you need less of a reason to exit a trade than to initiate one. So always in bulls, probably exit below 13. 14, another bear bar. Buyers into the close, so not great for the bears, but now we have a 4-bar bear micro channel, and that probably needs a second leg down, sellers above. And then 15, outside down. Now what do we notice about the outside bar on 15 relative to the prior bar? Look at the distance of the breakout above bar 14 and below bar 14. The market clearly went further below 14 than above, and 15 closed below the low of 14 and several prior bars. So this is decent for the bears. It's still probably minor, and there's probably buyers at the bar 10 low, but this is a little more momentum than the bulls would like to see. Really not ideal. In general, outside bars are trading range bars, expanding triangles, and this one is no exception. The majority of the bar is tails. We rallied, we sold off, we rallied. And I think at a minimum, we will test the low of bar 14. But again, tight bear channel, even though it's no longer a micro channel, this will probably need a second leg down. And we can go all the way down and test the moving average. So I think always in bulls are flat and maybe looking to buy a second reversal. 16, falling further. 16, not a great breakout bar. Big tail, buyers into the close, but fell a fair distance below 15. That was a fair amount of overlap with the prior bar. It's really not a great breakout. And if we looked at a smaller time frame, this would be a bear breakout attempt of a bear channel, which we know is low probability. But however, if we think back to the Globex chart and what I was talking about going into the morning, remember that this rally was a bull breakout of a bull channel, and most of the time those rallies reverse within 5 bars and then come back down to test the trend line. So this could turn into a major reversal. Right now it's minor, but we have 5 consecutive bear bars, and that's a problem for the bulls. If you're counting the pullback legs, we sold off, we rallied above bar 14. That's a high 1. We sold off. And if we rally above 16, that would be a high 2. But who's going to buy the high 2 after 5 consecutive bear bars and a big signal bar? And if you're buying high in a trading range. So not many traders will buy above 16, probably sellers above. Inside bar 17, we're pulling back, testing a breakout point. We broke out below the low of 14, and 17 is testing that low, but probably sellers here. Limited upside. Inside bar. So even though it's a trend bar, it's a non-breakout bar. It's totally inside 16. And then traders sold the close, and we sold off on 18. And now we have a low 1 short. The risk for the bulls here, if you're buying, is we could get a second leg down, 1 pullback 2, and test the moving average. So If it's likely we're going to test the moving average, traders won't buy here, they'll wait to buy at the moving average. And bears won't take profits up here, they'll take profits at the moving average. And let's see. Let's look at up to 11 o'clock one more time. At least one more time on the Globex chart, 15-minute. So we're getting the bull breakout attempt of a channel, and it's big bars and little overlap, good for the bulls, but now starting to fail after about 5 bars. That's a problem for the bulls, and the risk is that we sell off all the way down to this trend line here. Now on this chart we have a high 1 buy, but a 3-bar micro channel, bad signal bar, probably sellers above, and a second leg down, likely. And what about stop orders here? Would you rather buy above 18 or sell below 18? Again, it's not an easy decision, but you don't want to buy above bar 18. And if it's a bad stop order buy, it's a good limit order sell. So probably sellers above 18. That's what we got on 19. The bulls are trying hard to reverse this sell-off. We had a reversal attempt up on 17. Continuation, 18, low 1. It failed, pulled back deeper. 19, but now there's a low 2 short below 19. And the true low 2 occurred up here on some smaller time frame. And traders will go to a smaller time frame and look to enter on stop orders during a bar like 19. Others wait for the close of the bar. Maybe they sell below for a scalp. But at this point, would you rather buy above 19 or sell below 19? There's probably more sellers below 19 because we could easily sell down to the moving average. And the bears would get their second leg after a 2-legged pullback. 20, more sideways. We're in a tight trading range here. And breakout direction might be 50-50. If this is an overall trading range, the top of the range could be up here. But the problem is that for the bulls, the bottom of the range could be all the way down here. 21, a bear bar. It's a breakout bar. It didn't break out far below the prior bar, but it did close below the prior bar and the prior 4 bars. Good for the bears, but a lot of overlap. Still not great, and they need follow-through. 22, follow-through selling. Again, good for the bears, but not great. But this entire sell-off since bar 12 is a tight bear channel, and that's a breakout on a higher time frame. And if you think back to the Globex 15-minute chart, you think about that bull trend line far below the price, and that's a test magnet, and the market could realistically fall all the way down there before we find buyers. Consecutive buy climaxes, that's exhaustion. The bulls, they're exhausted, and they're not looking to buy again until after a more complex pullback. We have 2 legs down, but now we have a tight channel, and this could all be 1 leg on a higher time frame. That might need its own second leg down. More selling, 23. Now we have a 5-bar bear micro channel. And yes, it's 2 legs down, but again, it's tight, and it's all 1 leg on a higher time frame. And now we have a close below the moving average. So what about the moving average gap? Can you buy the close of 23, betting that we were above the moving average for a lot of bars, and the first test of the moving average should fail and get a retest of the trend's extreme? The problem here is a couple things. One is that 8, 9, and 10, tight trading range, possible final flag. We got the bull breakout and a reversal. So we may have seen the high of the day at this point. Another problem with buying here is the momentum. Just look at the buying pressure since bar 12 to bar 23. You have 1 bull bar, 17, and it's an inside bar, and it immediately sold off. So as far as buying here, I would not. 24, there is a give up bar. Now 24 is either a measuring gap or an exhaustion gap. There's a couple of ways I think through this. One is that let's think through targets to the left. Bar 1 remains the high or the low of the day about 20% of the time in general. So most days, bar 1 is not the low of the day. So there's a reason to get below bar 1. Does this look like a bull trend? Probably not. This is either a trading range or a bear trend at this point. And how many bars into this sell-off are we? Well, we're about 12 bars into a sell-off, and exhaustion is more common after 20 or 30 bars. So this could easily be a measuring gap, and we could sell off all the way down to here. And no surprise, look where the measuring gap measured move takes you, right down to the bar 1 low. So probably sell the close, always in short 24, probably going lower. This needs a second leg down. Even though it's already 2 legs down, this might have been a strong enough breakout to reset the count. And then the bears, they get minimum follow through. Let's see. The close of the bar is the same as the open of the bar, so we have a perfect doji. We rallied and sold off. Low 1 short for the bears. Not the worst stop order trade. Would you rather buy above 25 or sell below 25? Probably rather sell below 25. It's always in short. It's a low 1 short after a new bear breakout. A trader sold. And more selling on 26. Good for the bears. Maybe a little climactic. Maybe bear breakout attempt of the bear channel line. So more likely to pull back here. But with an obvious magnet below, the bar 1 low, and the measuring gap measured move, there's reasons for the market to continue lower. And if you're trading an always in style, there's no reason to get out here yet. Bar 27, we have a bull bar closing on its high. Is this a good double bottom to buy? Probably not. I mentioned the buying pressure up to this point, and still there's really not any buying pressure on the way down. And while 27 is a reason to get out of shorts, I'm not sure traders are going to buy above 27. Because 25 was an inside bar and inside bars get retested, it's possible we have to come back up here and test the low of 25, or maybe the low of 24. That's a breakout point. We broke out on 26 and fell further. So we have some test targets up here. But for the bulls, the upside is limited. This is not a good double bottom. This is a bear breakout. 28 pulling back further. We're testing around the low of bar 25. And it's the first reversal attempt after many bars down. Maybe an 8 or 9 bar bear micro channel. So more likely sellers above, but deep enough pullback to disappoint the bears. Also, if we think through the market cycle, bar 24 was a bear breakout, and 25 it's an implied pullback, an inside bar. This is the start of the channel phase. So if this is the channel phase, traders are taking profits below bars, and they're going to sell rallies. So probably more sellers above 28, even though it's strong enough for its own second leg. That second leg should be minor, and the buyers may not come in until below 27. And we immediately sold off on 29. Another low 1 short. If anything, are you selling below 29 or buying above 29? Obviously, you're selling. Tight bear channel, only want to look to sell. Now, it is a channel, so traders might be taking profits below 27, but there's still a risk that we fall to the bar 1 low, and we could fall a measured move down of this bear flag. This would be a double bottom attempt for the bulls. You can see right here. And if we break below the neckline, bulls, they want the opposite. We have a double bottom, break above this neckline, and rally for a measured move. The bears looking for the exact opposite. So a failed double bottom, break below, and a measured move down. What about buying above 30? Really not ideal. And there's a way you can count 3 legs down, 24, 27, 30, truncated wedge, and double bottom. So I think, again, it's reasonable to exit shorts above 30, but still pretty aggressive to buy above 30. It's a tight bear channel. It's a breakout on a higher time frame chart. We might test the 28 close, but I think the upside is pretty limited, and that's the best the bulls can hope for here. And then 31, a disappointing bar, did not even trigger the buy above 30. Another inside bar, consecutive inside bars, starting to go more sideways. Possible final flag, similar to up here. Bulls hoping we get the upside breakout and rally. This is a trading range, big up, big down, and then we get another big up rally. I mentioned the market cycle. The bar 25 high is a test target. Breakout, pullback, and channel. Channels evolve into trading ranges. And if it's a bear channel, we've had a couple of legs down, 2 or 3 legs down, then you expect a couple of legs sideways to up. And if we do come back and test the 25 high, the odds are there are sellers up here. Now here, there's an argument for buying above 32 because of the market cycle. It's more likely we're going to form a trading range here than get the bear breakout of the channel. And if that's the case, we might be low in the range and we could go all the way up to the bar 25 high. Consecutive inside bars, breakout mode pattern, and a bull bar closing on its high. Some traders will buy and look for that swing trade. 33, disappointing entry bar for the bulls, but it did break out, and any trader who sold above 32, fairly disappointed with 33. And now 33 is a low one short at the bottom of a trading range. Or you can call it a low 2. Low 1 below 28, low 2, 33. And either way, probably buyers below 33, and 32, 33 should get a second leg up. So we find buyers below the bad, low 2, high 1 buy, 34. Probably going to rally for another leg, but the upside is more likely limited. And if we do rally, it'll probably be a weak rally and be a leg in a trading range. 35, a little bit of a surprise. Bull breakout, closing above the moving average. Good for the bulls, but look to the left. We're still below this rally. So the bears looking for a double top here, and there's layers of resistance. So if we get above here, the next double top target is here. And this could be the start of the trading range where traders are looking to sell high in the range. And we also have a couple of open gaps if we look back. And look at the bodies. The close of 9 and the close of 17. There's a body gap, so there's some overlap. But there's a body gap, and then, clearly here, a big open gap up to this point. So we have trap traders above, and there's resistance above in those open gap areas. Bull breakout and follow through 35, 36, but there's a problem with the follow through 36. First of all, the context. We're still within the range of bar 25, so we could be high in a trading range, and 36 could be a second leg trap. Second leg traps often subdivide and they're nested, so 27, 28, leg 1, deep pullback, leg 2, and then right here we rallied, pulled back, rallied a second time. So 2 legs up, a couple of different ways, high in a trading range. And 36 is a much smaller bar than 35. So if you're buying a bull breakout and it's a tight trading range, in general, if you're entering in a breakout, you're betting on momentum and you want the price to move your way pretty quickly. So if you buy 35, 36 went your way, but why is it so much smaller than 35? And why is there so much overlap? 36 sold off and traders bought maybe a 30% pullback of bar 35 before it rallied. Take a look back over here. Look at bars 3 and 4. Very little overlap. This is much stronger for the bulls. As soon as bar 3 closed, traders hit buy the market. There's really no pullback here. And if you weren't quick, you likely had to chase the market and buy much higher. But here, the follow through is much smaller and there's a lot of overlap. So context and these two bars give you information that this might not be the best bull breakout. And then 37, we tested the high of 25 and fell, outside bar. We found sellers above, and now we have a low 2 short. It's a double top and a nested double top. Low 1, 33, low 2, 36 was the signal bar, triggered on 37. Now at this point, bears hoping for a double top and measured move down. So double top, neckline, break below here, and fall down here. The bulls, hoping this is just a trading range, we fall for a couple of legs and then find support in a double bottom and then rally. Outside bar, so bear breakout and follow through, 37, 38, but same problem with 38, a much smaller bar than 37 and a lot of overlap. So traders might prefer to sell a pullback. But traders who bought the close of 36, that's major disappointment. And if they're lucky, they would take it if the market came back and tested the high close of 36. But if this is a trading range, we could fall all the way down here. And, how much risk can the bulls tolerate? How much risk do they want to incur? Now, 39, we reversed, went outside up. So a deep pullback makes sense because the breakout was an outside bar and the follow-through bar had a lot of overlap and was much smaller. Traders are not selling. Bears are not eagerly selling and chasing the market down. So we pull back and are looking for sellers above. Remember, trap traders on the close of 36, looking to exit at break even. But 40 reversed down immediately. So if you're a bull and you bought here and whether you scaled in or not, the market did not get back to your original entry price. And then bar 40, I think if you're a bull, maybe you can hold long below 37. It's risky, but I think 40, you certainly need to exit. And that's another truncated wedge. We rallied a second time, tried to rally a third time, but now we have a lower high. This is a variation of a lower high major trend reversal. We have a rally trend line break, so 37, 38 broke this bull trend line, a retest of the highs, but obviously a lower high, and now the bears hoping for a bear trend. 41, a bear or bull doji bar. It's a trading range bar, and maybe the bulls are hoping this is a strong enough breakout for, even if there's a deep pullback, a second leg up. And now we have a high 2, high 1, 38, and high 2, 41. But it's completely below the moving average in the middle of a tight trading range, and the bulls just got trapped. Remember, there's open gaps up here, and if you think about always in, we're still probably always in short. We've gone sideways for a lot of bars, but the last strong breakout was to the downside. And this is all minor. 42 bear bar. We sold off, paused, sold off, paused, sold off again. That's 3 legs down, but this is minor. And on a higher time frame, this could simply be a bear breakout. So yes, leg 3, but minor. So maybe a brief pullback, but then this tight bear channel should get a second leg down. And then 43. Breaking out below 42, still minor. We are within this trading range, but 43 did not overlap 42 very much. Any trader who bought below 42, disappointed with their entry bar, they may look to sell out of their longs on the close of 43 or above 43. 43, not a good stop order buy, which means a good limit order short above. Why is it not a good stop order buy? Because this is too tight, and you can argue double bottom, but the signal bar is weak, and we have a 5-bar bear micro channel. The first reversal is likely to fail, and the bears will likely get a second leg down. And you can see nobody was interested in buying above 43. If they were, we would have gotten there, but we did not get there. Nobody bought above 43. Instead, we went sideways. A couple of sideways bars. We are at the bottom of this trading range, but this entire trading range could be a bear flag. A tight bear channel, trading range, but this entire sell-off might need a second leg down. And then 45, a little bit of a surprise bar. It's still probably always in short up to here, but 45 is obviously a big bar, and it's breaking below a lot of bars to the left, breaking far below the low of the day. Much bigger bar than all these bars. This is probably a major breakout, and this is probably resetting the leg count. And this can be tricky because you can always find an argument that it's 3 pushes down, maybe here, 1, 2, 3. But we went sideways for so many bars in here. Let's just think about it. And actually, there's a couple things. I want to back up and mention something else over here before I even get into this. I wanted to talk about this. I just remembered. Here's a contracting triangle. Lower highs, higher lows. We're in breakout mode. We get a bull breakout. Now, in general, triangles are 50-50. 50% chance you get the bull breakout, 50% chance you get the bear breakout, and 50% chance the first breakout fails and it reverses. And if you take the apex of any triangle, that is a test target. It's a magnet. And so if you see the breakout of a triangle, usually it's better to look to enter at the midpoint of the triangle, the apex of the triangle, rather than trying to buy up here. And look what happened on 37. The market immediately tested the midpoint of the triangle. Now, here's sort of the trade management logic. And because the chart's a little bit cluttered, let me just erase some drawings. So just remember that bar 37 is testing the midpoint of that triangle. If you're a bull and you had a limit order to buy the midpoint and 37 is your entry bar, that's not great. Limit order bulls, look back up here. If a limit order bull buys below bar 9, that's a good entry bar. The market triggered the buy and then reversed up and went their way. If you bought during 37, now you have a bear bar, which should get a second leg down. It's a big enough breakout and the context is good. So you might want to get out of that limit order long pretty quickly. We went sideways and then we bounced. Now, if you're a bull hoping for this to be a successful bull breakout, it's a fairly deep pullback. This needs its own second leg, so bulls will probably look to buy lower instead. And that was the buy setup, and it never triggered. And another buy setup, and it never triggered. And we got a give up bar. So 42 probably resets the leg count. But it's a breakout bar, and the bears need follow through. And then look at 46. That is a follow through bar. As soon as 45 closed, traders sold the market, and 46 closed on its low. So a new measured move target, the breakout and follow through down here. I usually have the high of the prior day. The high of the prior day is always support or resistance. In this case, expected to be support. And why is that? We had a trading range break above the high, and the market went far above. There are trap traders here. And if we come back here, the market will likely find support. But depending on the approach, if it's approaching with a lot of momentum, then the bounce could be really minor. And maybe there's profit taking here, but not necessarily a reversal. 47, we fell below the prior day's high. And it looks like bears got 1 times the risk if they sold below 46, stop above 46, scalping out. But do you really want to buy above 47? Of course not. It's a bear breakout. It's a terrible signal bar. It's a bear doji, and the bar is big. More likely, there's sellers above here, and this breakout needs a second leg down. So traders sell the close. Nobody was willing to buy above 47. So traders front run that sell, and they sell the close. So 48 bear bar, probably going lower. Let me just redraw that measured move. Likely that we're going there. And 49, we're getting there in a hurry. There might be profit taking, but again, the approach to this target is so strong that we could just bounce and find a minor reversal, bears taking profits, but the bulls need at least a trend line break after this. Now what the bulls have in their favor is that this is a major second leg down, 1 pullback, 2, and let's see, a leg 2 measured move. And look at that on bar 47. The low of the bar, 58, 54 and a half. That's a leg 2 measured move to the tick. So obviously traders paying attention to that target. That's interesting. Minor second leg, leg 1, pullback, leg 2, but it's a breakout. So if you're counting legs in the direction of the major trend, that's a mistake. This is a strong breakout, and it's probably going lower. And now we hit the measured move of the open of 45 to the close of 46, and we're finding some profit taking. It's a minor reversal. Probably sellers above 50 and going lower, but sell climax, pause, sell climax, far below the moving average. Traders will probably exit shorts above a bar, closing above its midpoint. And then we sold off again, 51. Now 51 kind of reminds me of bar 7. 51 is by far the biggest bear bar today. And you can just visually see that. You don't have to check. And if we think about the context, sell climax, pullback, sell climax, pause, sell climax. That's 3 consecutive sell climaxes. The sell-off began on bar 12, so we are about 30 bars into a trend. And remember what I said earlier about bar 24, measuring gap or exhaustion gap. Well, measuring gaps, let me put it this way. Exhaustion gaps usually come after 20 or 30 bars. And here we are, 30 bars into a bear trend. 51, the biggest bear bar, and 3 consecutive sell climaxes. There are reasons for the bears to look to take profits. Also 51, as I said, the biggest and strongest bear bar on the entire chart. This is classic for trapping beginners into selling. The trend looks weak all the way down. It's hard to get short. And, you watch it go and you're trapped out the whole time. And all of a sudden you see 51 and it's clear, finally, this is clearly going lower. I need to get short. And that's the exact opposite of what experienced traders are doing. Now, I don't advise buying 51, and I'm sure you can. There's probably a profitable system around this, but I think it's better to be short. It's always in short, and to be short. And then when you see 51, take your gift. It's a gift bar. It's acceleration in your direction, but consecutive sell climaxes far below the moving average. This is unsustainable behavior and likely exhaustion. So we'll probably test the high of bar 51 before we fall for a measured move of 51. So some traders will buy here. Maybe they'll wait for one more bar for no follow through. Put a stop down here and a target up here. 52. A 2-bar reversal, really strong bull trend bar. And, it's sort of a moment of clarity. Whenever there's a moment of clarity, it's kind of too late. Like as soon as it's clearly bearish, you reverse. Now 52, probably okay to exit shorts above 52, a big bull trend bar, and we're far below the moving average, getting consecutive sell climaxes. But the odds are 52 will pull back before it just rallies straight up. This is a big down, big up, big confusion. This is a trendline break, tight bear trend on a smaller time frame. 52 broke the trend line, but in this case, the buyers will likely come in below 52, not on the close of 52. Plus, it's a breakout bar, but only slightly breaking out of the prior bar and not breaking out of anything else. So it's a minor breakout, and it's a trendline break, good for the bulls, but likely a trading range here. So what do traders do in a trading range? They buy low and they sell high. Follow through for the bulls, but bad follow through, kind of like up here, 35, 36, a much smaller bar. This reminds me, it's a lot like yesterday. Look at these bars. Sell climax, maybe exhaustion, a big bull bar, but bad follow through. Probably buyers below 29. Smaller time frame, bear trend, trend line break, probably going to have to get a retest, and then a lower low, major trend reversal. So we could have something similar today. It's really similar. Breakout, bad follow through, probably buyers below. Is it always in short? It's not really clear at this point. It's more likely a trading range, but if it is a trading range, you're likely high in the range. So I think it is okay to be short. We broke below yesterday's high, the blue line, and we have a vacuum test, retesting it, but probably resistance here. Any trader who bought the high of yesterday obviously was trapped and disappointed with their lack of follow through. So they'll be happy to exit at their original entry price. So that's what we had on 54. But 54, as strong as 54 is, our trend bar is getting good follow through. 51, really strong bear trend bar, no follow through. 52, really strong bull trend bar, no follow through. So you really shouldn't count on follow through here. I still think we have to fall below 51, but probably buyers down here. And look what happened on 55. No follow through for the bears. It went further, but it's a trading range bar. It's getting confusing. It's a trading range, probably sellers above and buyers below. And then 56, a second leg down for the bears, and it's nested. 1, pull back 2, and 1, pause 2, buyers down here. The bulls will likely get a second leg, and the buyers will come in below. So this may be near the bottom of a trading range. So this is more of a buy zone. Now 57, a bull bar closing above its midpoint after a nested 2 legs down. And a possible, it's not a major trend reversal, but on a smaller time frame, there is a bull trend line break, retest, a weak retest. We sold off, rallied, sold off, rallied. Reasonable for bears to exit above 57, and some bulls might buy, hoping for what we had yesterday. They buy above 34, taking a chance we get this. So traders will buy above 57. 58, okay, entry bar, but you want to see more follow through. And if it stalls, traders will likely bail out of the trade. So stalling on 59, not ideal, but 3-bar micro channel, bad low 1, buyers below for a second leg up. And they front ran the buy below. They bought the close of 59, 60, raced up to the moving average. Now we have 2 legs up, 57, 58, pause, and then 60. And you can count 1, deep pullback, 2. And we're at resistance, probably sellers up here. If you bought the close of 53, you're very disappointed, and you'll take a retest and exit your long if you get the chance up here. So probably sellers up here. Bad high 1, 61, probably sellers above, and overall in a trading range. We went above, triggered the bad high 1, and had bad follow through. Another bad high one, you can call it. And it's confusing. It's implied pullbacks. So maybe you call it a high 2, 63, but whatever you call it, it looks like the market is high in a trading range and the signal bar is bad and it's an inside bar. A lot of reasons for sellers above here. 64, bull breakout, but might just be a vacuum test of resistance. 64 is a breakout bar, but it still needs follow through, and then no follow through. So when you don't get follow through, traders might just sell the close of 65, betting that now we have maybe 3 legs up to the top of a trading range, and after bull legs in a trading range, you get bear legs in a trading range. Another bad high one, buy 65, sellers above. And 66, we finally have a technical high one. We traded below the bar. This was a micro channel all the way up. But it wasn't a strong micro channel. This was a strong micro channel. The context was pretty good, but if we think about the bars themselves, very little overlap, uniform sized bars, no bear bars, no dojis, bars closing on their highs. It's a micro channel, and so is this, but think about the micro channel. A lot more overlap, climactic, buy climax, pause, buy climax, pause a couple more times, and lots of bear bars along the way. Context not as good as yesterday, more likely a trading range. So probably sellers above 66. Traders front run the sell. They sell the close, 66. Now we have a 4-bar bear micro channel. Not a great micro channel, but the odds are there are sellers above. 67 is a bad high one at the top of a trading range. The bears are hoping this is that we got a give up bar. Minor bull trend. Here's a bull flag. The bears want a bear breakout of a bull flag, and that would be a surprise leg one reset. Bear breakout, but pullback. Not a great breakout, but now, think about if you bought the close of 64, sort of an endless pullback here, and then there's your give up bar, 69. Strong enough for a second leg, but traders, now you're in the middle of the range. And it's better to sell high and buy low. So traders might wait for a deeper pullback to sell. That's what we got on 70. Traders saw the deep pullback, but looking for a second leg down. And 70 might be the start. 71 may be the start of the second leg down. 1, pullback, and 2. But as we go lower, we're going to get into the buy zone of the trading range. Bears who sold the close, 56, trapped on 57, and so on. So probably support down here. Bears will look to take profits. Bulls look to buy. This rally should get a second leg, but we can get a deep pullback first. 72, implied second reversal. We try to reverse on 70. Continued, low 1 short. Pulling back again. Maybe we get a deeper pullback and a low 2 short for the bears. And a low 2, 73. I'll be sellers above, and not great for a buy when this needs a second leg still, and there's a magnet below. Testing the moving average, tight trading range, 50-50, in the middle of an overall trading range. Really not the ideal place to be selling or buying, but because we had this bear breakout, this could be a bear flag before one more leg down. 75, a bad stop order buy, sellers above, probably going lower, and trying to break out for the bulls, but a very tight trading range. Stop orders get chewed up in here. This is a limit order market. Bear breakout, 77, probably going at least a little bit lower, but the downside I would suspect is limited because bears who sold down here were trapped, and they'll use any retest to exit their positions, and that's what we got on 78. And then just a couple more bars sideways to down into the close. So let's go through stop orders today. I think the first stop order was to buy above 3, probably buy the close 4. by the close or buy above 6. 7, a little climactic, not an ideal bar to buy. And then really not ideal to buy here as well, probably high in channel or trading range. Not a great stop order short all the way through here until maybe 23, but you usually just want to see one more bar and then you get it 24, so maybe you sell the close. And then through here, I thought 32 was okay, taking a chance that you get the bull breakout, but traders disappointed and they scalped out. And then the next, decent stop order, sell probably below 40, a second reversal. This needs a second leg. There's your second leg, sideways to up. That's what would prevent me from selling below 37, but then 40, reasonable sell. And then 45, sell the close. 46, sell the close. You might want to see the follow-through bar after 45, so when you get it, you can sell with more confidence. And your stop would be wider, but you'd have higher probability. And these are all sell the close bars. Still always in short. And then I thought there's a stop order above 57, a little aggressive, but okay to do. And then as far as stop orders go for the rest of the day, that's about it. Limit order traders were trapped out. If you're trying to buy a pullback on the open, there was no real pullback. Traders were looking to buy in the buy zone of each bar, which is the midpoint and below. The midpoint down in every bar is the buy zone, and the midpoint up is the sell zone of bars. But even that, you weren't getting a chance to buy a pullback until up here. Limit order buy below 8, it's a terrible sell. But after 3 pushes up, you might get a deeper pullback, so proceed with caution. Better to buy below 9 because at that point, you had 2 implied legs down. There's a limit order sell above 14, bad high 1, and micro channel, top of a trading range or channel. Another tight channel and micro channel, 18, bad buy, so good limit order sell. So here's an interesting thing. 27, you wouldn't sell above 27. It's a bull bar closing on its high, but traders will sell above the most recent strong bar, 26. So there's a limit order sell above 26. The market raced up there and then found the sellers. And let's see. Bad low 1, 28, buyers below. Sort of a limit order market in here. Traders fading breakout attempts. So there were sellers above 32 or 31 or 30, but these are inside bars. Reduces the probability for breakouts. But if you sold above 32, you're probably disappointed on 33, and you exit with a small, maybe break even or a small profit. But traders not interested in selling here because the market went against them, and then you get a second leg. Limit order sell at the high of 25. If you're thinking about the market cycle, spike, pullback, channels evolve into trading ranges. There's the top of the range. But after a 3-bar micro channel, maybe not the easiest trade to take. Limit order sell above 38, bad high 1, and a breakout and follow through for the bears. And you're fairly high in a trading range. Sellers above all the way down, but they never got triggered. Buyers below 52. And then buyers below here, but never triggered. And really not ideal because it's a trading range. So if you're looking to buy through here, it's in the middle of a trading range. Sellers above 61, 63. These are bad high 1s at the top of a range. Sellers above these bars, but they never triggered. Low 1, 70. It's an inside bar. It's the middle of a trading range. Traders will buy below it, but it's a scalp. And limit order market through here. Buyers below bars, sellers above bars. That's about it. So today you can call it a bear channel. Low, lower low, and lower highs on the way down. But there's a lot of trading range price action. But the trading range price action was sort of broad trading range price action, meaning you had minor trends up and down. Look at all the overlap here. We rallied, sold off, big up, big down. And then it's the same thing over here. Big down, big up, big down, big up. So a lot of the day spent a lot of time more sideways. If you're a bear and for some reason you sold the open of the day and you used an extremely wide stop, you obviously would have been able to avoid a loss. And that doesn't happen if it's a bull trend from the open. So this is a trading range. This is a trading range. But obviously through here, it's a pretty tight bear channel. Now, where do we go Monday? Tight trading range, low one short, signal bar relatively big. It's a good looking signal bar, but it's right at the moving average. It's right at support, right at breakout point here. Any trader who sold here got trapped. This becomes support. He bounced out on it a couple times. It doesn't look like a major reversal pattern. I think the bears still have to do more, but this might have been a final flag. The bears are hoping to get back down to the midpoint of this trading range at a minimum. Overall, it might be a big trading range all the way down here and all the way down here. But for now, bars are getting bad follow through, and trends are not getting good follow through. So if you call today a bear trend day, there's probably buyers below, and I suspect Monday will disappoint the bears. There's too much overlap. And again, we're just right at support. This breakout point, the moving average, this tight bull channel might get a second leg. We're getting a pullback, but we might have to get a second leg up. Now, if we do reverse here or from here, we will say the bulls did get a second leg from here to here. That's a second leg, sideways to up. But was this enough? I'm not sure. We have 6,000 right here, big round number, and I'm not sure if we're going to get up here. We might have to get up here before we get any major reversal and test swing points on the way up and convert into a trading range. Now, before I wrap up this video, I want to share some thoughts I've had today after talking to a few friends about systems and trading in general. And first of all, I don't know exactly who my audience is and whether you who are listening is a day one beginner or a 20-year veteran. I really don't know. And I hope to be of service to anyone and everyone in between those extremes. But the point is, it doesn't matter if you're a beginner or not. This message is for everyone, and I hope it helps everyone. If you're anything like me, you've studied Al for a number of years and you have a pretty good understanding of price action and the material that Al presents. Again, I'm speaking from my own experience here, but in case anyone can relate, this is why I'm sharing this. You might get to a point where your chart reading is sufficiently good, but your trading is not. And Al does say that chart reading and trading are two different but equally challenging skills. And this is one of the most frustrating parts of the journey. And that's because you're not confused anymore when you look at a chart. You have a pretty good understanding of what's happening, yet somehow you still can't capitalize on it and trade well. I have years of experience developing chart reading skills, But as far as trading goes, I consider myself a beginner, and the skill of trading has to catch up with my chart reading. And, you know, when I say that, I sort of don't mean that. You know, I don't have to, how do I put this? I don't have to trade at a level that my chart reading is at. So it really, the trading does not have to catch up to the chart reading necessarily. And I'll get into more of what I mean by that. My ability to read a chart is a blessing and a curse. And I mean, it's great that I can read a chart, but that doesn't mean I can then go and trade however I feel using my emotions and discretion. A beginner has an advantage over me for a couple of reasons. And there are obviously disadvantages as well, which I'll briefly touch on. But if we think about a complete beginner, a beginner doesn't have any ideas on trading. In theory, you come into it and have no idea about anything. They don't know what they don't know. So they're totally ignorant. And that's not a bad thing. That's just the way it is when you start something new. So my goal with these videos and with sharing ideas like this is that I want to help people save years of struggle and suffering. And while I'll always believe there's a price to pay, I also believe that a trader can become profitable within a year if they study the right material and apply it the right way. And I'm not just saying that. I've seen it happen. When I started studying Al, I was 18 and I was clueless. All I knew was that I wanted to make a lot of money, and that was it. But I had no guidance. So I took Al's 3 big textbooks and tried to read and digest all the material as fast as possible so I could take what I learned to the charts. Now, the advantage that a beginner has, if they take my advice, is that you don't have any bad habits to break, and there's really not all that much information to learn. And I'll get into that also, because that sounds crazy if you just look at the thickness of Al's books and the amount of hours in the video course. Stay with me. If a trader has been trading for 20 years and is still unsuccessful, chances are they have bad habits that need to be broken, and that's a lot of undoing to do. And it can be done, but it's more difficult. Think about it this way. A person who is not a beginner has to change their mind. A beginner has to make up their mind. So that's one advantage. Another advantage is, as a beginner, you have the ability to keep things simple and not overwhelm yourself with information. I mentioned that I tried to read Al's books as quickly as I could, and that's not the way to do anything. I'm a firm believer in quality over quantity. I'd rather see someone read the same page over and over until they understand what they're reading than see them fly through the books but miss a whole lot along the way. And I overthink all the time, and I go very in-depth with my chart reading and in these reviews, but it's not necessary at all. And let me give you an example. One of my friends was joking around today, and he said if he did end-of-day reviews, we'd all hate it because this is all it would be. And he went on to say something like, bar 1, strong enough, it needs a second leg. Bar 2. So bars 1 and 2, strong enough, needs a second leg. Bars 1 through 3, needs a second leg. Bars 1 through 4, needs a second leg. And on and on. And then up here, maybe at this point this needs a second leg, but at this point, this needs a second leg down. 12 through 16 needs a second leg down. And you get the point. That's all it is. And so, in reality, I think he'd be great at it. And I'm not going to disclose who this person is, but this is a person who took a handful of simple ideas, first principles of price action, including breakouts and second legs, the market cycle, leg count, and context, and he became profitable within a year of studying Al Brooks. He has this ability to keep things really simple. He doesn't care about the intricate details. He doesn't care about all the minor patterns. He asks himself a very simple question on every bar, and that is, does this need a second leg? I'm a trader who has a bad habit of wanting to be Albert Einstein. If you've ever heard Brad or Al talk about that, they joke that Forrest Gump would be a better trader than Albert Einstein. Now, I want to capture every tick, and when I enter, I want the market to not go against me. And, I want the perfect entry in every scenario. And I want to be a trader like Al or Ali or Brad. And I've already mentioned before that perfect trades can't exist. And I'll try to find that video at some point. I'll post it as a clip on here. I think I talked about it at the end of one of my reviews. But anyway, the point is, there's no such thing as a perfect trade, so don't waste time looking for one. Learning to trade a system takes a couple of things. You have to know what your goal is, and you have to execute your plan. While learning to trade, I highly recommend trading a size that you truly don't care about. For example, you could take 10 losing trades in a day, and at the end of the day, only be down $5. If you have the privilege of trading the SPY, or you can trade Forex, that's what I would do. This is directly from Al. You first have to learn to not do dumb things. Then you have to learn how to trade. Then you can worry about making money, but the least of your concerns should be making a lot of money. And that's ironic because I mentioned what got me into the game in the first place. And everyone wants to get rich. It's what lures all of us into it. And if you can just find a system that can be applied over and over, and it works, you just slowly scale up and let compound interest do the rest. But anyway, I've been rambling, and I want to close this by saying that, sometimes you can get burnt out. You feel overworked. You feel like you've been studying hard and you still don't get it. You're not seeing results. And we've all been there. And I know someone needs to hear this because I still need to hear this from time to time. I think everyone does. Rest and recovery are just as important as anything else in the formula for success. If you go to the gym and lift weights, you're breaking down your muscle tissue. And that's how you stimulate growth. But the growth doesn't come in the gym. The growth comes from rest and sleep. That's why the great bodybuilders from the 80s went hard in the gym and spent the rest of the day laying on the beach. And I'm exaggerating, but you get the point. So the point is this. Sometimes there are concepts that you literally have to sleep on and really think about for a long time for them to sink in. And one more thing I also want to mention is I'm thinking about creating a membership for this channel where I would post exclusive videos for anyone who is really interested in going deeper into specific ideas. And also I want to make videos where I combine ideas I've learned from my other mentors like Bob Proctor, John Canary. And I found those guys through Ali. And I'll actually link a playlist to videos I watch from them if anyone's interested. And those are ideas you get from Napoleon Hill, who wrote Think and Grow Rich. These videos are much more personal. And to be honest, they're more for me. I'm not sure anyone would really be interested in even watching them. But if you're interested, they'll be there. And I'll make a separate video announcing this, but for now, I'll just leave it at that. All right. Thanks, everybody, for watching, and I hope everyone has a good weekend.